Hey, it's Randy Hatada here with Xpand Realty, back again to introduce a product that you may or may not know about, but it's a hot topic. And we have one of the experts that actually provides that type of loan product, and his name is Sean Uyehara. So welcome, Sean.
Thanks for having me, Randy. Appreciate it.
Sean's been on, and on his last episode or my appearance with him, there was a lot of questions that came out of that. So I know there's a lot of demand in this world, and looking forward to asking you some questions, Sean.
Let's do it.
I'm actually going to be the person asking this time and getting the answers. But the hot topic right now, and it seems to be getting hotter by the day, is first position HELOCs. And I know a little bit about a little. And so we're going to learn kind of together.
Yeah.
And I know conceptually, I've been to so many seminars about paying off your home in 10 years and versus 30 and all of that. So I'm going to have a lot of questions pertaining to that and how to use the tool.
Absolutely. It's a great product. It's one of those things too. I mean, even for me, until I really dived into it, it wasn't anything that I was really aware of. But now that it's something that we use quite often, I think it's a total game changer. And I hope more people can start to understand the tools that are out there to help them reach financial freedom faster.
I think, well, let's start with the definition of HELOC. So HELOC simply means home equity line of credit. And I think a lot of people are familiar with home equity lines, but not familiar specifically with a first position home equity line of credit. Because traditionally, home equity line of credits normally get piggybacked on as second position to a regular mortgage, right?
Correct. Yep. Exactly.
And so traditionally, that's usually how it works. As people pay down their mortgage or have appreciation, they both equate to equity. And with that equity, people pull out lines of credit which they can utilize.
Correct. Yep.
And so it's a pretty popular thing, but the first position HELOC is something that I don't think is as common to the public world, right?
No, not as much as the second position. I mean, I know just in my almost 20 years of doing this, I've never had a lender that we've worked for that actually produced this product. So it's pretty rare. And I think when a lot of people do hear HELOC, they automatically think the traditional type of banking product that we're all normally accustomed to. But this being in first position, there are some similarities to a normal HELOC, but also some differences. But when you look at the differences, it is, totally mind-blowing when you kind of look at it on paper as far as what it could do to a mortgage.
Yeah, and I think a lot has to do with the simple mathematics that we may or may not understand, but at the end result, we know what the result is, and it's pretty amazing. I've seen a lot of people use it as pay off your loan quick strategies. I've seen them use it as banking strategies. I've seen people use it as investment strategies. So it's being utilized in many different ways. I guess let's start with the number one question is, what exactly is a first position HELOC?
So the first position HELOC, we can do that strategy both on a purchase and a refinance. So if you were buying a property, whether it be a primary home, vacation home, or investment property, it would serve as your mortgage, if you will. If you own a house, this HELOC would take over the first position. So we'd pay off your existing loan, and then this would be the existing mortgage going forward.
So you can do it through your purchase of a home.
Correct. Yep.
Okay, so I learned something today. That's new to me.
Yeah.
I'm always thinking refinance or just pulling it out of your equity, not as a purchase tool.
Purchase and refi, yeah. So that's also been a strategy that we've been looking at, especially because a lot of buyers today are very concerned about the interest rates. And when you look at the effective interest rate of what you could potentially accomplish, the first position HELOC, I've seen a lot of clients where we've got their effective rate of what they're truly paying interest-wise as low as 1%. And some people will say there's no way, but when we go through the exercise with the client, we put everything in a calculator as far as their income, their debts, and everything, and it actually spits out the number to us. So we can truly show them how powerful this could be to them.
So I think there's two parts to it, right? One is having this tool, which it is a tool.
Yep.
And then two, understanding how to use it for your purpose, right? Because it can be also abused just like a credit card, right?
Absolutely. I think that's also in the back of a lot of people's minds is knowing that if you have access to your equity, some people, they flat out said, I'm afraid that I might spend it, which isn't a good thing because, like you said, that's a slippery slope to be on if you have access to $100,000 today.
There's a lot of shiny objects out there.
Yeah.
Yeah, and being in Vegas, there's a lot of cha-ching out there, so
Yep.
you just have to be accountable for spending on
Absolutely.
it, right?
It's actually, I've had this conversation with a client because their whole goal was to buy a rental property, and they're targeting some homes in the Midwest. And when I show them this loan, I think we'd end up paying off their mortgage in 4 years. And their strategy after that, the wife was telling me, she's like, well, what if we bought a car? I was like, no, you can't buy a car. I said, the whole purpose of you doing this, when we first spoke, it was to buy your rental property. I said, buy the rental property in cash, which they could afford to do with the line of credit, then go buy the car. So to your point, that shiny object, knowing that they have access to the money, they were already thinking of buying the vehicle.
So I noticed that there's a lot of programs out there that coach these techniques. Mm-hmm. But a lot of the coaching is actually accountability partners for that reason.
Yeah.
Because you got to stick to the system in order to pay your house off in 8 to 12 years. You got to stick to the system.
Absolutely.
It doesn't happen by accident, right?
Yep.
All right. So let's just go through the basics then. What's the difference between a first position versus a regular mortgage?
So when you look at just the interest alone, the interest on the first position HELOC is simple interest. So it's calculated daily. So the lower that we can get the loan amount, the less interest you end up typically paying in that month. So I like to tell a lot of our clients, just think about it how a lot of people try to kind of gamify your credit. You have the closing date and then you have the statement date. So if you can pay off your credit card before the closing date, then when it reports to the bureaus, you get a higher credit score. And with this loan, the interest accrues to the mortgage around the 21st day of the month, every month. So if you can keep your loan balance as low as possible up until that date, you can sort of gamify how much interest you end up paying the next month. That alone right there, the biggest thing. The other key piece with this loan is that you have access to the equity for 30 years. So unlike a traditional HELOC where you might have access maybe up to 10 years, and right now we're starting to see a lot of banks shorten that window to 3 years and sometimes 5 years. With this loan, again, you have access for 30 years. So that really helps save transactional costs with refinancing down the road. And for a lot of people that like HELOCs, maybe you're having to requalify for one every 5 to 10 years, and you're starting that clock all over again.
And that means that 30-year term is locked, correct?
Correct.
They can't pull it away from you during that term.
Right. Yep. You'd have access.
Which has happened to me before.
Yeah. There was a lot of that happened when the market crashed.
Right. Market crash, you lose some equity, and they pull your line.
Yep.
Right.
Yep.
So, all right. Well, that's a good note to take if you guys aren't familiar with this whole concept that the term is locked for 30 years. That is a big deal, and we'll explain why. When you're purchasing with this product, I assume you need 20% down, something like that?
It's going to be based on the occupancy, just like traditional financing. So if it's your primary residence, we're looking at least 10% down. Investments and second homes, you're looking at 20, 25% down.
Okay, so explain to me how that works. So you have a line, you put down, for example, 20%. The line is 80% of your home?
Correct.
And it's maxed out at that point?
It would be maxed, yes. So as you start making your payments and contributions into the line of credit, you're immediately creating the equity in the property.
Gotcha. So with every payment towards it, then you get more flex on that line.
Yep, exactly.
Okay. All right. Cool. That makes sense. I took some notes here. So what are typical interest rates behind HELOCs right now?
Right now, you're looking at about, on a traditional HELOC, probably going to be somewhere between 8 and maybe 10%.
Okay. Higher.
On this product today, we priced one out. It was about 8.5%.
Okay. And why would that be better than getting a mortgage 6-7%?
When you look at a traditional mortgage, and this to me is kind of the eye-opener, if you really look at an amortization schedule, you'll see that the banks front load all of the interest. So on a typical 30-year mortgage, you're probably paying out of your traditional payment maybe the first 12 to 13 years, a lot of that payment is going towards the interest. And on this loan, it's because it's simple interest. And whenever you make a contribution or a payment towards the HELOC, 100% of that amount goes towards the principal.
So that makes sense to me. And if you guys ever bought a home before and you get to the closing table and then you get your amortization schedule and it tells you how much interest you're going to be paying over 30 years, and then your pen kind of goes like this. That's what he's talking about.
Yeah.
So it's not front loaded in that way.
Right.
And I think one main component though is that understanding that mortgages are going by compounding interest and that this product is going by simple interest, which is completely different. Maybe are you able to explain the difference between the two?
Yeah, when you look at the amortized mortgage over the 30 years, when you sign your loan docs, it'll actually break out your principal you're paying back and then the interest. So it's already predetermined that assuming you held the loan for 30 years, they already have the interest calculation based on the loan. And for a lot of times, you're probably going to end up paying probably double, sometimes even triple the actual borrowed amount. And with this loan, with the first position HELOC, because every time we're making a payment or a contribution, we can knock down the principal, you actually get to control how much interest you pay the bank. So if you have, other sources of passive income that are coming in, you could apply that. If you're a real estate investor, maybe you flip a house, you've got some extra cash from your tax returns. So the more money that you can essentially apply to the HELOC, you would sort of mitigate some of the interest that you're actually going to end up paying back the bank.
Yeah.
But on the flip side, like we said, if you aren't disciplined or if you overspend, now the interest can obviously go the other way too.
Right. You just have to be disciplined in following the system.
Yep.
And you need to set up the system based on whatever you're trying to accomplish. And I think most of us, or most of you guys probably are thinking paying down that loan as fast as possible. Because a lot of people are like, I want to pay off my loan on my house as soon as possible, right? And pay no more interest. And again, the good thing about these lines of credit is that you don't pay on what you don't use. Whereas as you paid on your mortgage, it's a set amount, and that does not change for whatever it is, 20, 30 years. Yep. So let's talk about well, first of all, I know the answer, but I'm going to ask you anyway. Is it a rumor that you can pay off your mortgage in 8 to 12 years with this product?
Yeah, you can definitely do it. A lot of it obviously will be predicated upon the individual client. So depending on how much money they make and their savings rate.
Well, let me rephrase the question. I'm sorry. Because you can do that with a mortgage too by obviously applying more payments. But you can pay off your mortgage in 8 to 12 years without changing your lifestyle that much.
Yes.
That's the key word, right?
Yes, that is. And that's actually a big factor of what we look at when we talk to any of our clients about this product is, can we take your current lifestyle, your current spending habits, and does it translate to paying off the home in 8 to 12 years? And if the answer is yes, in most cases it always is, then obviously we dive deeper. But on a traditional mortgage, the only way you're paying off the house faster is you're adding more money towards your principal payment every month. And I will say this, if you are doing that, make sure you are specifying that the money goes towards principal and you're not just making extra payments because they'll throw it towards the interest.
Here's a hint. If you apply an additional payment, almost always it'll automatically go to another payment for next month or whatever it is, right?
Yep.
Versus going directly to principal. So you got to specify that.
Yeah. And I think obviously by doing that, yes, you do cut down the lifespan of the mortgage. You can also cut down on the interest. But the drawback is now you're creating equity that's tied up in your house. So the only way you're going to pull it out is through a HELOC or a refinance, which again, you could be altering the payoff on the mortgage compared to the first position HELOC where if we're adding more money, I could pull that out tomorrow at the same time.
Yeah, this is a great conversation. So we're going to try and continue keeping it high level. I'm not going to get you into the weeds. You guys can call Sean and do a one-on-one with him to get all the details. We're going to try and keep this high level so everyone can follow along here. But how is this used to pay down the debt faster, specifically?
Again, any contribution or payment that goes towards a HELOC, 100% of that deposit will go towards the principal balance. That feature alone helps accelerate the payoff. You know, we say 2 to 3 times faster at least compared to your traditional mortgage.
So let's make it as simple as possible as an explanation, so my grandpa can understand it, right? So I have a house, I have a first position HELOC, and I'm on salary.
Okay.
I think one of the strategies is I take all of my income, meaning my payment, my pay stub or my paycheck every 2 weeks. I dump my whole paycheck into the actual HELOC and kind of use it as my checking account.
Correct.
And while that whole paycheck's in there, I'm not paying for that amount of interest because it's not being used at that time.
Right.
And then I use that to pay my expenses that I normally would pay out of my paycheck.
Yep.
So my car payment, my
utility bills, credit cards,
the fender bender I just did, whatever.
Yeah, I need new tires. You can pay it from there. So yeah, essentially.
And we're talking about normal expenses, guys. So let's not get this out of hand. Normal expenses that you normally would pay out of your paycheck.
And a good way to think about it is just thinking of the HELOC as being your checking account in its simplest terms. So money comes in through your payroll as if it would go to your checking account. You can automatically get that deposited to the HELOC. So the minute it hits the HELOC, it's going to lower the principal balance by whatever that dollar amount is. And let's just say, for ease of math, it's $5,000. So if I owe $300,000 on my house, my balance would now be $295.
Right.
And
it's calculating by the day.
Correct.
Right.
Correct. Yep. So if I don't spend anything and I can float some of my
bills. So you don't want to pay your
bills
bills until the last minute.
Yeah. If you can do it, and then as you start to pay your expenses, let's say it's $3,000. So that balance will go from the $295 to the $298. And then let's say, I get another paycheck at the end of the month, that would reduce it another $5,000. And I'm only paying interest on that unpaid principal balance.
So that's the myth, you guys, that you can pay off your loan, your mortgage, or in this case, your HELOC in about 10 years on average by utilizing this concept. And the concept is simple, like taking all your income and paying your expenses with the line of credit versus a checking account. So based on the mathematics of daily calculations and simple interest, that is how that is achieved, right?
Right. Correct.
Okay. All right. Simple. So we're not trying to overcomplicate this because there's a lot of big words that I've been told that I'm like, it's pretty simple.
Yeah. I think a lot of people just get confused with paying my bills from the HELOC, and I think just throwing in the HELOC word and then the mortgage, I think that makes it a little convoluted. But I think if you just associate the HELOC with a checking account and that's how you bank, that's all you're doing, really.
I'm curious how that would actually work in real life, though. Like, so you're paying your bills. In real life, if it's a checking account, you'd probably be using bill pay because not too many people use checks anymore.
Yep.
Would it be the same electronic concept, or how would they be making these payments?
Yeah, the HELOC has all the same functionality of regular checking accounts. So you can do bill pay, you have checks, you get a debit card, all the same functionality is there. So you're not going to lose anything.
Don't get a debit card.
Yeah.
And if you do, don't bring it to the casino. I didn't say that out loud. Just have constraint. Be responsible when you do.
Yes.
What else do I have here? Okay, so we talked about how you can pay your debt off for your primary residence pretty quickly. Mm-hmm. Can you do that the same for a second home, for an investment property?
Absolutely. Any of the properties, it would work. I love this strategy even on a rental property because now...
Hear that, guys? If you're an investor, this is where you tune in.
Yeah, because now not only do I have my earned income or other income that I have, but now I can take that passive income from the rental and add that towards the deposits, which, if you're adding another $500 a month or whatever it ends up being, you should be able to pay the house off even faster.
Right. And so in a real estate investment world, it would be, okay, we own the property. You probably have a property manager. Hopefully it's us. and we're collecting the rent, we're processing it, paying you guys, and then as the maintenance bills or anything comes along, then you're using that to pay those bills.
Yep.
So you got to let your property manager know that you want to wait for the last minute to pay for whatever bills you're owed, and you still have the opportunity to direct it back to the management company or directly to the vendor or whoever that expense is coming from. Yep. You just need to understand through whoever is managing your property what the process is, but you still have that control of using this product.
Yeah, absolutely. And then whatever net proceeds you receive at, throughout the month, apply that amount towards the HELOC, and then you could then pay your mortgage off of the line of credit after that.
Right. And let's talk about how to use this as an investment tool now. Most people are going to start with your primary residence, right? Yep. And eventually, if they stick to the program, pay it down very quickly or have a lot of equity in the line. And now, how do you use that to invest?
Once you start to accumulate enough equity to maybe take down a second property, if you're financing it, you could write yourself a check, use those funds to deposit, for escrow and to get that rolling. Or for a lot of our clients, if they're paying off the home in, call it 3 or 4 years, they may choose to wait and then pay cash for the next rental property. And then you would essentially pay cash for the home and now take all of that rental income that you would get back towards the line of credit with your income again and sort of rinse and repeat that process. So you do have some flexibility. I don't think you always need to leverage the next home because obviously, you just may not be comfortable taking on a second mortgage. So I think even if you were a little more risk averse and you had a $400,000, $500,000 line of credit, you could pay cash for your next rental.
So guys, there's multiple ways that I know of how to use this line of credit as an investment tool. Mm-hmm. But what I would highly recommend to anyone, even the sophisticated investors out there, is to get, if you're not that, someone in finance to help you navigate leveraging, because you are leveraging when you're using it. But as far as acquisition, it is considered cash. Right. The line itself is considered cash, which means you can use it for your down payment, your closing costs, or for buying a property outright. Yep. And then you can talk about even refinancing later into a regular note, thus paying back down. So there's multiple strategies in using that. Mm-hmm. You could even use it for your down payment, and then now you have a mortgage, but now you're fully leveraging that property. And it's very important that you understand the cash flow dynamic behind fully leveraging it, because at the end of the day, that's 100% financing, theoretically. Now, another good way to use this is that because it's considered cash to a seller, you could go into a competitive, or maybe not even a competitive market. You could go into the public market, and because now you're a cash buyer, maybe you can navigate a better deal. Talk to your realtor about that, but you should be able to out leverage and get a better deal, or even get the acceptance before potentially a financed buyer, if that's the case. But at the end of the day, cash is stronger than a financed buyer for multiple reasons. Talk to your realtor about why, but that's not the conversation today. The conversation is that you can use this to get a better deal on your investment, better deal on your purchase if this is your primary or investment. And then there's multiple ways you can use it because it is cash. But just remember, it moves and acts like cash, but it is not cash. You're leveraging. So just be careful that you're doing it with the data behind it. Make sure you do your diligence before you pull the trigger on that.
Yeah, absolutely. And I think it's just understanding, like you said, even working with a realtor that understands it, a lender that understands it, because there's a lot of ways you can acquire it. Buying a rental cash, pulling out a HELOC on that one, or refinancing it. Yeah, there's just a lot of ways and strategies of what you could do. But I think it's really cool to have the ammo to do it versus I'm trying to save, $60,000, $80,000, $100,000 to go find my next rental property when I can utilize the equity in my house to help me get to financial freedom faster.
Is this a product of your brokerage, or are you brokering it out?
We use another lender.
Well, share what your brokerage is.
With Geneva Financial. So
Geneva, right?
Yep. Yep. So we're approved with another mortgage bank that offers this product.
So you broker it through another bank?
Correct.
Okay.
Yep. Yep. But it's very rare that, like I said, in my almost 20 years of doing this, that we've actually had access to this loan. And it's just amazing to me that not many people are aware of it, and not many other lenders carry it too. So I think it's, for us, I'm grateful that we have it because it's a great tool that I've used for myself and just now trying to educate a lot of our clients on, try to get them out of the rat race.
Let's break down another myth buster. A HELOC does not make sense because my mortgage is locked in at 3.5% or 4%.
Yeah. Yeah, that's a big one. A lot of folks are stuck on that interest rate. And I get it. The whole real estate and mortgage industry, they really drive that home, I think, more than
I mean, it's an amazing rate.
It is. But when you look at the mechanics of, again, the bank amortizing that loan, it's front loaded with interest. And when you compare that to the simple interest alone, like I said, a lot of our clients, we've seen effective interest rates of 1%, sometimes even under 1%. I had a client that effective interest rate.
So
the effective interest rate is essentially when we model out the loan, and let's say you're paying it off in 4 years. We can have an idea of how much interest you're actually going to be paying back in that 48-month window. So when you take that interest, that's what you're truly paying. And if you were to calculate that out on the loan, it'll then give you an effective interest rate.
So much people are going to be helped with this product.
It's crazy. I had a client, he owed $1 million on his house. I talked to him about this. He's like, Sean, I'm not touching my loan. I'm at 2.5%. I said, can I just show you the program, right? I'm not trying to get you to refinance. I just want to show this to you because you're a money guy, you're an investor. I think it'd help you. So I put his numbers in, and we would pay off that $1 million loan in, I think it was 20 months.
Less than 2 years.
Less than 2 years, and he had 27 years left on his mortgage.
Yeah, but he got it at 3.5%.
That's exactly what I told him. I said, hey, look, now do you still want to keep your 2.5, or are you open to the idea? And I think that's the thing for a lot of people is, they get really stuck on their 3 and 4.
Well, let's recap that scenario. Would you rather pay 27 years of 2.5% or 2 years of 8%?
Yeah, exactly.
Right? That's what it comes down to, right?
Exactly. Yeah, and that's
how much savings is that?
Huge. I think it's 6 figures at that point. So I think that's where, just understanding the money process behind it and what it really means to you as a homeowner, to me, it's a conversation you should have, because if not, no matter what you do, right, you're stuck in that house, unless you sell it, but you're going to pay it off in 30 years. But if we could wave a magic wand and say, again, without changing your lifestyle, could you be done with a mortgage in 5 years?
This is it sounds very complicated, guys, and it can be. But what it really comes down to is simple. It's not simple. It comes down to mathematics.
Yeah.
And the thing that I love about mathematics is that it's pretty black and white.
Yep.
There's not too much gray in mathematics. Everything else, there's gray areas. Math is pretty cut and dry. So if the numbers make sense, the numbers make sense. But the one thing I would caution you guys is that you are aligned with your goal, because some people's goal is not to pay off early, right? And maybe some people's goal is, I don't want access to my equity, right? And so you just got to be aligned with what your goal is and what the intent of this product is. Once you are, then the rest is mathematics.
Yep. And that's why whenever we talk about this loan with any of our clients, we get on Zoom. I share a calculator with them, and they're giving me the numbers, right? How much money they make, how much money they have saved. They can see. I'm plugging it into the calculator. And at the end of the day, it spits out the number. Mm-hmm. So it's not me swaying this thing one way or the other, and then it compares it side by side with their current mortgage. So you can see how fast you pay it off. You see how much interest you're saving, and you see, the effective interest of what you're truly paying back to the bank. So it's black and white.
Black and white. Cool. Well, as long as you guys create a system and follow the system, then the math is going to do the math. Yep. Amazing. I think there's going to be a ton more questions, but I think we covered most of the what this is and why it works, right?
Absolutely. Yep.
I hope you guys liked what you heard. I certainly, as you can see, I'm very, this excites me. This really motivates me to share more with you guys because I know this product will help so many people in a multitude of ways. And if you guys have been listening to me and heard, the message beyond just education in general, it's not just for you guys to pay off your debt. It's to get in the best financial position, which is not normally just paying off your debt. So there's a big difference. And so depending on what that means to you, then there's different strategies. And I think that a lot of us need to figure out what our goals are, and we can utilize the product to best serve you. And because I'll give you an example. It may start off with paying off your debt, and now that it's paid off or very low, how do you use that to leverage into investment property? Or how do you use that to better your situation? Or how do I use that to consolidate debt? Or there's so many different things that this could be used for. But me being in real estate, me being a real estate investor, and me believing in real estate investing and believing in Las Vegas, I really try to push like home ownership, number one, and then real estate investing, number two, because it's a conservative investment play. It hedges against inflation, and it appreciates over time. Mm-hmm. Temporarily, there's volatile times, but over the long period of time, houses simply go up. Yeah. At the end of the day. And so I like that, and I like creating generational wealth because we're all at different stages in our life. And when I'm at a point where hopefully I have grandchildren that I need to take care of and, pass along some financial help to, I'll have real estate to depend on rather than just blood, sweat, and tears, which is sweat equity.
Yeah. And I think, one of the things too, I feel the same way about understanding this loan is just there's so much education out there about buying houses. Buy a house. But once you're in it, I feel like there's a huge drop off with people giving you information on how to pay your home off faster or how to build wealth. And I think a lot of times you hear, people that they want to buy a second home or a third home for all of their kids, but they don't know how to get there. And I think this strategy, if used properly, I think it can make a lot of those dreams realities for people. And it doesn't take, you having hundreds of thousands of dollars in the bank or making, a ton of income to get to that point.
So if you're interested, I think your question would be, how do I start? So how would someone start?
First thing I would do is just reach out, let's get on Zoom and talk through your scenario. And I think the education piece to me is the biggest part. We start there.
And start, I mean, like, how do I get more information? Yeah. That's step one, right?
Yeah, absolutely. Let's get on a Zoom call, and then we'll walk through the specifics of your loan. And then if it's something that remotely looks interesting, and I always have everyone to make sure and dive into their numbers as far as their income that's being deposited, and then also what they have saved at the end of the month. Because as great as this loan is, those two factors can also be an Achilles heel too. So we just want to make sure we're not overstating what we make and we're not understating our expenses too.
So guys, I hope you guys like what you heard. I hope you guys took a nugget or two from this conversation. Step one is to reach out to myself or Sean or someone that specializes in this type of product and get educated. That's step one. Find your resource of information or your consultant and get educated. Now, I have a personal interest in this. The first person I'm going to share this with is, guess who? My wife. She just doesn't know. But I might have to just share this video with my wife and, have her hopefully hopefully I get the blessings to move forward with it, right? Because we got to be on the same page. And then we also got to create a contract saying, okay, for me, no extra fishing poles and reels, and for her, no extra purses, and then we can move forward.
That works.
Yeah. Well, thank you for your time today, Sean. We'll put your contact information up above. And you guys always have our information, and feel free to pick our brains or comment below if you have any questions that we can address, simple questions, or any topics you want to learn about in the future, because that's what we're here for. Other than that, reach out and we can give you detailed consultations and advice or simple Q&A. And at that point, you can make your own decisions on what makes sense for you.
Yeah, absolutely.
Well,
Totally agree.
Thanks, Sean.
Thanks again.
Thanks, you guys. Thank you
See
for
you guys.
tuning in.